Hey, man. I'm good. I'm good. Were you going to attend the meeting? I'm just okay. No, 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 I don't.
Good morning, everybody.
Good morning.
Nancy, can everybody hear me? This is Lori Carney, clerk of the board. Nancy Dean will be absent from the meeting today. I'd like to call the meeting to order, and since she is absent, I would like to nominate Lazaro Guzman to serve as temporary chair for the meeting. Are there any objections? No objections? Then without any objections, Lazaro shall serve as temporary chair today.
All right. Thanks, Lori. Welcome, everybody, to the virtual February 22nd meeting of the West Hartford Pension Board. I'm Lazaro Guzman, and I am interim chair for today. Because in-person attendance at public meetings is likely to increase the risk of COVID transmission, this meeting is being conducted in accordance with Governor Lamont's Executive Order 7B, which permits municipalities to conduct public meetings virtually. Members of the board and some staff are participating via WebEx, and members of the public can view the meeting live on West Hartford Community Television or on West Hartford Community Interactive Comcast Channel 5 and Frontier TV Channel 6098, or at www.whctv.org. The meeting is also being recorded for on-demand viewing, which will be available on the town website. Because of the virtual format, there are some special rules and procedures that I need to cover before we begin. First, I ask all participants to please mute your devices, computers, when you're not speaking. If you wish to be recognized, please raise your hand, and I will call on you in the order that I see hands go up. If you are participating via audio only, or I do not call on you and the debate is ending, then please unmute your phone and let me know so that I can recognize you. Second, main motions will be made by me, and no second is necessary. We'll proceed immediately to debate. These include motions to adopt, receive, or approve business items. Subsidiary motions will require a second. These include motions to amend. A member must be recognized before making a subsidiary motion, but any member can second the motion by just unmuting their line and saying second. Third, pursuant to Executive Order 7B, all speakers must state their name and title each time they speak. Fourth, because of the difficulty in tallying voice votes on a video teleconference, I will require that all votes be taken by roll. Fifth, a reminder that if any participant has a problem with their connection, you should immediately call Ureta Reinheimer, whose number you were provided earlier. She will let me know, and we will recess the meeting while your problem is resolved. If it cannot be resolved quickly, we will ask you to call into the meeting using a phone and participate via audio only. I want to thank everybody in advance for their patience with the virtual format. Lori will now call the roll.
Okay. Thanks, Lazaro.
Thank you, Lori.
So Lazaro Guzman,
Present.
Alan Lebo,
Here.
Ethan Goldman,
Here.
Brittany Birmingham,
Here.
Peter Privatera,
Here.
and Nancy Dean is absent. Sherry Cantor,
I'm here.
thank you. Matt Hart,
Matt's going to try to join us later on in the meeting. He's not here right now.
okay, thank you. Chris Kashmar,
Here.
Rick Ledwith,
Here.
Lee Gold,
Here.
Paula Kanaki,
Here.
and Jennifer Evans with Community Television set up the recording. Is there anyone who's participating whose name I have not called?
Yes, this is Becky Seelman from Milliman.
Thank you, Becky. Is there anyone else? Okay, Lazaro, we're ready to go.
All right, thanks, Lori. The first item on the agenda, and again, welcome everybody, is Brittany Birmingham, Town Matters.
There are no town matters to report.
Great, thank you, Brittany. Next on the agenda, Rick, let's see, I think you had meeting schedule for 2021.
Thanks, Lazaro. Rick Ledwith. The schedule you can see is on page 4A. Our next meeting right now is scheduled for May 10th. That would be the last meeting of the year, followed by September 13th for 2021. Being told there may be an additional meeting scheduled between now and May, and you'll hear more from the board chair on that if that's going to happen. Thank you.
Thanks, Rick. I guess, do we take that back and just make sure, confirm that everybody can make those meetings, or do we want to do that now?
In terms of the meetings that are in the agenda,
Yes.
well, I know that those were presented in December for review, so I think we've agreed to them already.
All right. Peter?
Good morning, Lazaro. I think we're going to have a special meeting. It just hasn't been determined when, because the board still has to finalize the investment strategy after the pension bonds are sold. So if we sell the bonds in late April, May timeframe, I'm sure that there's going to have to be a meeting in the interim. I know that Becky had worked with Al on running the scenario, so I'm sure that needs to be presented as well before the final strategy is approved. Thank you.
Okay, thanks, Peter. So, and I think we'll coordinate that via email, I'm assuming.
Yes.
Just in terms of getting a special meeting scheduled. Next is approval of the minutes. I'll make a motion to approve. We've got minutes from January 25th. and then from February 12th. I'll do each one individually. Motion to approve the minutes from January 25th that were in your packet.
Just one moment. Okay, Lazaro Guzman,
Approve.
Peter Privatera,
Yes, approve.
Brittany Birmingham,
Approve.
Alan Lebo,
Approve.
and Ethan Goldman.
Approve.
Thank you, motion carries.
All right. Thank you, everybody. Next, I'll make a motion to approve the minutes from our special meeting on February 12th, which were also in everybody's packet.
Okay, Lazaro Guzman,
Approve.
Peter Privatera,
Approve.
Brittany Birmingham,
Approve.
Alan Lebo,
Approve.
and Ethan Goldman.
Approve.
Thank you, motion carries.
All right. Thanks, Lori. Thanks, everybody. Next, pension administration. Those items were also included in the packet. I'll make a motion to approve all pension administration unless anybody wants to go over the items individually. I just want to confirm that none of these items were non-standard, correct?
Good morning, everyone. It's Rick Ledwith again. Lazaro, the only thing that I would say is a little atypical would be the pension disability. So we do have an employee who, as a result of a disability that has arisen out of their course of employment, is permanently unable to continue performing the same employment responsibilities that they were hired for and performed prior to the disability. The employee has received a determination of maximum medical improvement under the Workers' Compensation Act. And because it's work-related, we did have our outside workers' compensation attorney involved pretty extensively, as well as our risk manager. And again, based on all the medical information provided, this employee is permanently disabled as a result of 2 back injuries. The first one was back in 2005. And the most recent one was January of 2019. So the board would have to approve this pension disability in addition to all the normal routine matters that are in the agenda.
Great, thanks, Rick.
Answer any questions that anyone had.
Anybody have any questions for Rick? Thanks, Rick. So with that, I'll make a motion to approve all of the pension administration items.
Okay, Alan Lebo,
Approve.
Peter Privatera,
Yes,
Brittany Birmingham,
Approve.
Ethan Goldman,
Yes.
and Lazaro Guzman.
Approve.
Okay, motion carries.
Peter, I'll turn it over to you. I think you're next on the agenda with the discount rate and discussion on the scenarios.
If I could, this is Lori, clerk of the board. Would you want to handle the invoice right now, or?
Sure. Oh, I apologize.
It's
I missed
just a
that.
separate, we do a separate motion for that.
Great. Thank you. Motion to approve the invoice from Reed and Riga, included in everybody's packet. And I will pull up the amount here in a second.
I have it in front of, it's the $2,428.65.
Thanks, Lori. Al, do you have a question?
Yeah, thanks, Lazaro. This is Al Lebo, board member. Can we just, does this have to do with the disability? I just want clarification as to what this was for.
Hi, it's Rick Ledwith again. This is not for that disability, Alan. This is based on phone conferences that took place between Reed and Riga in our the town's corporation council office. And this is regarding pension benefits for 2 participants who are in the town's pension plan, but also eligible for benefits from another plan. So there was some legal discussions that took place between Reed and Riga and our inside council.
Okay, thank you.
You're welcome.
Okay, regarding this invoice, motion to approve, Al Lebo,
Approve.
Peter Privatera,
Yes.
Brittany Birmingham,
Approve.
Ethan Goldman,
Approve.
and Lazaro Guzman.
Approve.
Okay, motion carries.
Next, I'll turn it back over to Peter and Becky for the discount rate and the discussion on the scenarios.
Thank you. Good morning, Pete Privatera, Finance Director. If you recall, every year when the actuaries prepare the pension valuation, we run different scenarios on discount rates, and we deliberate and we settle on one rate. This is a very unique year because the discount rate that we have, the recommendation is to maintain that because that discount rate was the basis for calculating the funding for the pension bond reserve fund. So I'm asking the board to maintain that discount rate because frankly, all the documentation that we prepared so far with respect to the pension bonds and the funding of the reserve fund are based on that rate. So I'm asking for the board's approval. Thank you.
And Peter, just for informational purposes, I guess maybe for you or Becky, just, kind of how do we compare to other municipalities with a similar asset allocation in terms of discount rate?
I'm going to turn that over to Becky because, I've heard different stories that the average in Connecticut is still above 7 slightly, but I think that for the most part, most of the higher credit rated municipalities are under 7 in the high 6s. But Becky, I'll let you comment on that.
This is Becky Seelman from Milliman. I think the key thing you said, Lazaro, is with comparable asset allocations, and that's key. It doesn't matter what the town next door is using for an interest rate if they have a more aggressive or a more conservative asset allocation. We have had discussions over the past couple of years about how your discount rate is a little bit high relative to your asset allocation. With the July 2019 valuation, we reduced the interest rate assumption to 6.99%. As part of our analysis of the pension obligation bond, we used the discount rate of 6.25%, which builds in a margin for conservatism. But for the July 1, 2020 interim valuation, which is what Pete is referring to, we prepared all of our analysis, including the pension and obligation bond analysis, assuming that the discount rate would remain unchanged at 6.99%. So the request is to approve 6.99% for the July 2020 valuation. With July 2021, which will reflect the pension obligation bond proceeds, we will reduce the interest rate to 6.25.
Okay, so we are going to reduce it for the next vow to 6.25.
Right.
Okay. Any other questions for either Peter or Becky? I see a hand, Al.
Yeah, thanks, Al Lebo, board member. Peter, you said that you want to keep it at 699 because all the paperwork and all that kind of stuff is done at 699. Can you tell us what are the implications, if we were to change it, what would be the implications of that?
Well, Pete Privatera, Finance Director. Not because all the paperwork is done, because all the projections were based on that. Let's say if this board decided they wanted to drop the discount rate to 6 3/4%, that would mean that the unfunded liability would increase for next year, and the funding required for a normal ADEC payment would increase significantly. One of the reasons we maintain the 6.99% is because we knew that we're going to drop down to 6 1/4%. So let's say, for instance, our pension contribution next year is $26.9 million. If this board voted to drop it down to 6 3/4, that could jump up to $27 million, which would mean that would put a greater burden on the town at this point in time during a tough budget process to increase the ARC payment for next year. Because remember, if we don't sell the bonds next year, if we don't sell the bonds in the spring, we still have to make that ARC payment next year. So that would add an additional burden to the town, plus the fact that Becky would have to, rerun her scenarios. Not that she wouldn't want to, but we'd have to rerun all the documentation and paperwork that we've already sent to the state for their approval and review. So,
And this is Becky, and just to remind everyone, the ADEC that results from this discount rate decision is not actually going to be contributed to the pension plan. It is going to form the reserve fund that will then be used to provide budgetary stability for the life of the pension obligation bonds. So, and we've determined from all of our modeling that the reserve fund we're establishing based on a discount rate of 6.99% is a very solid number. So having a lower discount rate and a higher amount in the reserve fund is unnecessarily high relative to what the reserve fund is supposed to be doing. The reserve fund determined based on 6.99% is a sufficient number. Having more money in reserve fund would not have any particular benefits for the town.
Ethan, I think you've got a question.
Yeah, I had a question. Assuming the scenario works out with the pension bonds, when do you anticipate the rate would change, as stated? Ethan Goldman, board member. Sorry.
This is Becky Seelman. For the July 1st, 2021 valuation, we would use a 6.25% discount rate.
Thank you.
And Becky, 6.25%, that's where ultimately we had wanted to land. At that point, we wouldn't be, a little high. We would be just where we want to be, right?
Lazaro, we'd actually be a little low.
Okay.
This is based on analysis that we did at the start of the pension obligation bond process. We've since had, we started that in December of 2019, and we used our July 1, 2019 capital market assumptions for that analysis. Since then, we've had several newer iterations of our capital market assumptions that would undoubtedly have different outcomes. But based on that analysis, 6.25 was actually a little low relative to the long-term expected return on the portfolio.
Okay, and being a little low equates to being more conservative, just to confirm for everybody. Okay. Any other questions for either Becky or for Peter? Not hearing any questions. Oh, actually, well, so I'll make a motion to approve the interim valuation discount rate of 6.99%.
Okay. Alibo,
Aye.
Peter Privatera,
Yes.
Brittany Birmingham,
Yes.
Ethan Goldman,
Approve.
and Lazaro Guzman.
Yes.
Motion carries.
Thank you, Lori. Next topic is the discussion of Milliman's scenario analysis for different market scenarios and how that would impact the purchase of the POBs and the reserve fund. So I'll turn that back over to Peter and Becky.
Yeah, Lazaro, it's Pete Privatera. Actually, this is all on Becky. So Becky, you can have a discussion this morning about the different scenarios that you and Al talked about.
Yeah, so Al and I had a good call last week to discuss using our model to run additional scenarios, and I provided Al with the technical details of the format in which he could provide us with additional scenarios, and we could run them. And we talked some more about the purpose of running additional scenarios. And finally, we talked about what the pension board would do with the benefit of that additional information. And I don't want to speak for Al in terms of what he concluded from the basis of that conversation and how he would like to proceed. But I think what we came to in very broad brush strokes is that the worst possible outcomes with respect to issuing pension obligation bonds is if the market had a significant decline shortly thereafter. And I actually pulled up, after our conversation, I pulled up the worst possible scenario that we have out of the 10,000 is that is the 100th percentile in terms of the highest town cost over the bond period. It's scenario number 6,571, and boy, is it awful. I'd be happy to pull it up on screen if you'd like, but I'm just glancing at it. The first year in the whole scenario when the return comes anywhere close to 6.25, let alone being higher than it, is 2033. And in the meantime, there's a -3, a 0.7, 1.2, 2.7, -4.7, -28. Oh, here we go. 2028, we get a 13% return, but it's negative and persistently negative for a long period of time. And although there are some years at the very end of the projection with some favorable investment results, it's just abysmally bad. And on that basis, the net present value of the town cost with the pension obligation bond is $1.2 billion. Now, without a pension obligation bond, it's still abysmally bad, and the town's contribution and the town's overall cost is over $1 billion. So it costs more with the pension obligation bond, but it's still horrendous. In either with or without the pension obligation bond, there are years either way where the town's total cost is more than $100 million. But what we talked about is, so what does the pension board do with this information? What steps can you take in order to protect the town against having significant market downturn? And that's really part of your purview, arguably, whether or not there's a pension obligation bond. It's just that you have an awful lot more assets with the pension obligation bond than without. And we talked about that dollar cost averaging that we had laid out as part of the pension obligation bond analysis. Maybe that should be longer than a 6-quarter process. Maybe it's a 2 or 3 year process. Maybe it would be worthwhile to consider some sort of a hedging overlay. Maybe there are some changes to the asset allocation that might provide some more protection. Those are all things that you ought to be talking to Chris Kashmar about. But that's the real risk, is an immediate, steep, and prolonged market downturn. So Al, I don't want to speak for you. I am happy to run more scenarios, but that, in a nutshell, is kind of what I think you were looking for.
Al, go ahead.
Yeah, thanks. Al Lebo, board member. Yeah, thank you, Becky, for that summary. Yeah, so I mean, generally that is what we discussed. Specifically, though, there are a number of scenarios here which I have created and which I would like to submit and have you run for us. So there are actually two things I'd like to do. I'd like to, number one, run these specific scenarios that look at specific situations to understand just exactly how they would play out. And so that we could then, once we have those, take a look at, what if the investment allocation is different? What if the dollar cost averaging is longer? What, if we do different strategies, how does that play through? So that once the bonds are sold and we have, that much money to deal with, we have a better idea of exactly what our decisions mean as far as managing that money. And so in order to do that, there's a handful of specific scenarios here that I've created and would like to ask Milliman to run for us. And the second thing that we discussed that I'd like to do is I'd like to get copies of the 5 worst scenarios, and worst is defined 2 different ways. One is the one that ends up costing the town the most money over the time period. The other one, though, is the one that ends up with the single, we have annual time steps, so the single year's worst cost. One of the things that unfortunately can happen with this kind of modeling is you can get a scenario where, it's actually very favorable to do this deal. But it's favorable because what happens is there's a large market drop followed by large market recoveries, and you sustain a period of time that the town couldn't actually afford to fund, and the assumption is that we do fund it and then later recover. And so I'd like to be able to see that and understand that kind of situation and see what we can do to mitigate that from happening. Now, my understanding is that, doing these handful of scenarios should not be terribly costly. It's a matter of sort of getting those loaded into the model that already exists and just simply running them. The scenarios themselves I've already developed. There's no work on Milliman's part. So all that really needs to be done is convert that. Just write a macro that feeds that into the system. I think you can also feed one of your existing scenarios in the same way and use that as a check to make you get the right answer. And so one thing I would like to do is appropriate maybe as much as $5,000 to be able to cover this. My personal thought is that we shouldn't come anywhere near using that much money, but I'd like to be able to have money available for us to do the analysis. Thank you.
Thanks, Al. And Becky, in terms of what we're talking about, the number of scenarios, does it sound like the 5,000 at least to start would cover probably the majority of what we're looking at, or all of it?
That would be more than enough, yes.
Okay. Thanks. And Becky, can you remind me in the and that includes Al's, mine, and I think Ethan had a request also, so that the 5,000 would cover all of the requests that we're talking about at this time.
Yes, that should be plenty.
Thanks.
And to clarify, I think that should be plenty, not only to run the scenarios, but also to then look at different investment mixes and analysis after we've run the scenarios.
Correct.
Great, thanks for the clarification now. Becky, just remind me in terms of when we ran these scenarios, the dollar cost averaging, did we model the dollar cost averaging as currently proposed by Chris Cashmar? So when we looked at the returns for the first 6 quarters in the 10,000 scenarios, we were ramping up, we were holding short term and then ramping up our equity exposure. That's how it was modeled out, correct?
That's correct.
Okay. Thank you. Any other questions at this point in term regarding the additional analysis for Becky? All right, if no other questions, I'll make a motion to approve $5,000 for additional analysis that includes the additional scenarios and then potentially any other scenarios that might tweak the asset allocation.
Okay. Al Lebo,
Aye.
Brittany Birmingham,
Approve.
Peter Privatera,
Yes.
Ethan Goldman,
Approve.
Lazaro Guzman.
Approve.
Okay, motion carries.
All right, thanks, Lori. Thanks, everybody. Next on the agenda, Chris Cashmar, Investment Review, DeMayo Schneider.
Hey, thank you, Mr. Chairman.
Am I free to go?
Yes, thank you so much, Becky.
Okay. All right. Bye-bye.
Have a great week. Bye.
Bye, Becky. I think we provided the board, Mr. Chairman, 2 documents. Happy to go through those in whatever level of detail the board would like. But if we start with maybe just hit a couple of highlights and then take direction from the group. Kind of a nondescript month if you had a chance to review the flash report. Markets were a little bit of a mixed bag in January, I think, as everyone well knows. We had interest rates ticking up a bit, which put a little bit of pressure on bonds broadly. And then that kind of trends under the hood that we've seen now for several months running with incremental performance on the equity front from U.S. small cap and emerging market equities persisted in January. Larger cap names in the U.S. and developed markets were down a touch in the month. And that all rounded up into a return, if you saw for the month, just slightly positive for the plan. We had it up about 10 basis points for the month of January, about 0.5% ahead of the broad benchmark that we use to footprint and compare that performance. And then fiscal year to date, July through end of January, the portfolio, as you all know, has had a nice run, up about 18.8%, with the benchmark up 16, and the 1-year period ending in January, the plan is up 17%, the 1-year number of 14%, and the longer dated numbers, I think you're all kind of familiar with that pattern. We can probably leave those aside. So we do have the plan benchmarked from a value standpoint at $254.6 million at the end of January. From an allocation perspective, the portfolio kind of running as I think the board has grown accustomed to, nominally overweight equities at the expense of fixed income, not dramatically so. Probably all things considered, right, given what interest rates have been doing. Just the relative valuations and opportunities, near-term equity versus fixed income, a couple of incremental points to equity, certainly well within the policy statement prescriptions. By default, I think would continue to be our preferred stance. And then the lineup of managers, no issues to report to the board either. We've got all the managers on maintain kind of positioned and performing consistent with our research expectations. So that, Mr. Chairman, is a quick run through. I'm happy to pause there for a minute and see if the group has any questions on any of those numbers or information.
Al, did you have a question?
Yeah, thanks. Al Lebo, board member. Chris, it looks like we're also under our target in real estate. Any thoughts about that?
Yeah, we have been running out a little bit under on real estate, but I think, bear with me here. Let me just pull up the actual numbers as a frame of reference here. Yeah, running about a point inside that for a period of time now. I think, as everyone knows, right? That's an interesting couple of things as backdrop, right? Just as a reminder for the board, that Barings strategy is grade A property space in what Barings labels a barrier markets, right? The Washington D.C.s, the New York Cities, Boston's, the Los Angeles, San Francisco's. It's kind of a grade A property, fairly plain vanilla portfolio, all things considered, but it is operating right with a touch of stress. Right, just given the circumstances. And we've been perfectly content at that size, right? At 4% of the portfolio, we think it's still meaningful enough to offer an element of diversification. There's a little bit of a yield profile there, if you will, and kind of an advantageous positioning just as a different source of yield in the program, but are comfortable letting that run a little bit shy of the benchmark, again, just given all of the circumstances collectively. And I think, as everyone knows, right, the format for dollars in and out of that strategy, right, comes with a little bit of foresight, right? Because we've got to make the presentation to Barings in terms of the town would like to take money out or the town would like to put money in. And there is a process there over a few months time frame in the form of a queue either way. So I guess that's long-winded, but we're fine with the positioning. I think it continues to size the way it should, all things considered, and don't feel the action or the need rather to take action on the balance right now. If the board's inclined, I think in our larger packet that we had presented last month, I think it was last month, or the month before, you should have access to more of that detail if there were additional questions that you'd like to address. But I think we're in good working order right now.
Okay.
In that manner.
Ethan, you have a question?
Yeah, I had a question. And this is probably my lack of, or just being new to the board. I was looking at some of the performances of, I'm sorry, Ethan Goldman, pension board member. Looking at some of the performances, particularly in fixed income over time. When do you look to see, or about when it's time to, whether the investment group that you're using should be relooked at?
Yeah, sure. I think Chris Cashmar, DeMaio Schneider, Ethan, I've been described to the board in the past, but just at a very high and quick level to reiterate, right? So we're using, our research analysts are using kind of a combination of quantitative and qualitative data, and are trying to marry the numbers actually are, of course, right, and the details around those numbers versus just our sense of the teams, and abilities and kind of, the attributes that they have that attract us to them in the first place. So we have, because of the depth of analysis that the analysts are doing, we do have fairly long leashes, as the board will know, with managers, right? And we think we know them particularly well. And we know that there will be periods, even with the very best managers in a track record, relative numbers might be softer than are longer term, just by virtue of where we are in the return cycle in markets. So within fixed income, right, the board has always taken a very conservative stance. The pairings there that you note are a combination of the index fund, right? So the Vanguard strategy obviously is not going to do anything other than mimic the benchmark or the return to the broad benchmark in markets. And the Ethan, right, the relative competitiveness of their rank, right, is really not a byproduct of Vanguard, good or bad, right? It's just indexing at points in time looking more compelling than other times in the cycle. So you can see there over time, the index is ranked anywhere from slightly above median to below median, and then more recently, right, January, for example, a little bit challenged in terms of those numbers versus a universe of active managers, which of course is the mantra that Metropolitan West fills.
Yeah, I understand that. It's consistently, and I assume I'm reading this right, in the bottom half. In the question, and I know Vanguard's a very good name. I'm assuming this is after cost of the investment manager. It's a total return.
It is after fees. So you're right. So the Vanguard, that is that is a philosophical thing, indexing versus active, right? So I'm always cautious when you look at the rank. It's not an indictment, as you point out, of the manager. It's just an indictment philosophically, whether you like active or indexing. And I think that the benefits of indexing obviously are cost economies, right? And then again, I think what the board has done over time is tried to marry that thoughtfully from a cost perspective to a conservative active manager, which would fit that bill for sure. We've looked in the past at other types of strategies, right? We looked at a dedicated high yield strategy for a little bit of time, and the board decided not to pursue that, which is fine. We've talked about global bonds. You can certainly run up and down the spectrum, right, of aggressiveness. There are managers in MetWest peer group that are much more or consistently more aggressively postured, right? So you'll see their numbers when markets are really working be higher, but obviously in the first quarter of 2020, for example, they'll be lower. So I think the board has always thought about 30% of the assets are in fixed income. We want to have those dialed down and locked down in pretty conservative mixes. And we'll take our total return seeking opportunities elsewhere in the form of the equity sizing and the type of managers being used.
Yeah, Chris, my question wasn't so much the mix; it was more the ranking of the manager over a long period of time. That was it. So I was just curious. And then if I could have a follow-up question. Would we look at these for pension obligation board, or would we be using the same managers? I'm sorry, the pension obligation bonds.
Great question. So, yep, I think what part of the exercise, right, that will ensue in the coming months is how we what implications there may be, if any, for the existing portfolio that you have in place, right? And so consideration there is centers certainly right on the idea that you're putting a fairly significant amount of monies into the program. And that can have implications, right, for the sizing of the existing mandates, right? I think there are certain areas of the markets in small cap and internationally where we may need to think about broadening out those segments a little bit in terms of the number of managers. There can be capacity issues that we need to be sensitive to. There may be, and we can, I will certainly have this conversation with the board, right? There may be the opportunity, given the size, to look at all, different asset classes altogether. So there certainly will be, I think, implications ultimately for what the portfolio centers on in terms of its configuration and its composition. But certainly on the front end to start, you've got, as you all know, a pretty diversified portfolio across asset classes and by entity, certainly. And there's a lot of capacity to accept at least the front end of those monies. So
yeah,
I think, Ethan, your point's a well taken one, right? I think we're going to have detailed conversations around the board's comfort levels on just what this portfolio looks like going forward. And that's something that we've always, we've starting to noodle on our side, of course.
Chris, and again, I want to make sure. I'm looking at the performance. I'm just curious when we say we need to relook at it or look to another manager, but it was just a question. So thank you very much. I'm all
sure. Oh, okay, great. Thank you. I don't know, Mr. Chairman, if there's other questions around January.
Chris, I do have two two things. Since we started talking about just, I know Ethan's question was more around Vanguard, Vanguard specifically, but maybe mine is around the mix in fixed income. And maybe just tell us a little bit about your philosophy of indexing versus active, just very quick, high level, active versus passive, specifically within fixed income. It seems like, active managers do have a decent shot at outperforming the index net of fees, but, I'm curious what some of your thoughts are. And then also, as we think about investing, a higher amount of dollars, would you recommend that same sort of active passive split, or what are your thoughts there? And maybe, some thoughts around what other folks do in terms of active versus passive splits within fixed income.
Sure. Great question. So certainly, think about where we are in the interest rate cycle, right? So we've got rates that have been very, very low, that have just started, as you all know, to edge a little bit higher as last year ended into 2021. And while we don't expect interest rates to increase dramatically over the course of the next several quarters, we're certainly mindful that they may continue to tick a touch higher. All things equal, right? All things equal, when rates are moving higher, to Lazaro's point, active managers probably have a better chance net of fees to add value. If you look kind of historically at how those return patterns in those categories work out. So I think that there's probably in this portion of the cycle a little bit of a sense that of skewing maybe a touch more in active management could make a good deal of sense. I say that alongside the larger question you asked about just what ultimately does that portion of the portfolio look like. So I think the answer might be ultimately that we end up somewhere in between. And what I mean by that is I can certainly foresee, just from a cost economy and tracking error perspective, having a touch of indexing remaining in the program, but maybe Lazaro broadening out a little bit beyond Met West with some thoughtful active management with proceeds alongside that, if that makes sense. So I think you probably end up somewhere in the middle. Still keeping a touch of indexing, but maybe with a couple more managers other than just Met West as the sole dedicated active fixed income manager. And again, right, we'll do that work and talk about that particular configuration and what the board's comfortable with as we come into the spring and start to hunker down on what the strategy you adopt is ultimately.
Great, thanks. And then the other thing that I had is looking at my notes from January 25th, we had talked about rebalancing the portfolio back to 70-30, and we had identified a couple of managers where the dollars were going to come from. Maybe you can give us an update on that.
Did we? I'm Peter too. I don't recall.
I think we did move some money.
Did we? Hold on, folks. I'm sorry. I should have looked here. Let me just see if I can get at my data.
A couple of weeks ago.
Yeah. And my network is down. So if I could, Lazaro, report, I'm sorry, right? I should have looked at this ahead of time. You're right. I think we did make some money movement there, at least marginally, to address the overweight. And I can come back to the particulars with the board. I would do it right now, but I don't have access to the network.
Okay, but it sounds like some of those transactions have already occurred.
Yes.
Potentially. Okay. That was my question, because it wasn't clear when we did the review, but I appreciate that.
Yep, that's my fault. Yep.
No worries. Any other? I guess just in the interest of time, other questions? Al, you've got another question? Go ahead, please.
Yeah, Al Lebo, board member. This is just a follow-up to the question you just asked, Lazaro. The rebalancing that you're talking about, did that happen subsequent to January 31st? Is that after the sheet that we're looking at, or is it included in this?
I think it happened, Al, right after. So if it pleases the board, what I'll do is I'll go back and get the particulars and verify with Peter that detail. But I think it was after the January prints that you see on your screen or on the report.
Yeah, I believe it was.
I think we did it in the first half of February. So I'll clarify that for everyone. I should have looked it up. I'm sorry beforehand.
Okay, Chris. Ethan.
Yeah, and again, this could be, I'm sorry, Ethan Goldman, board member, pension board member. This could be my lack of knowledge again. I'm looking and it says total bond market fund. My hope is as we go into the pension obligation bonds, that we sort of use short-term bond possible managers. Just because my fear is not just the stock market going down, but the interest rates sparking up could cause an issue. So that's just a comment. So it's, but that's fair to mention it. And I don't know the process. So thank you very much.
Go ahead, Chris. I think you talked about just re-looking at our mix and the different types of managers. So I think we're going to build that out a little bit more in conjunction with how we think about investing the proceeds from the POBs. Correct?
That's correct, Mr. Chairman, and Chris Kashmar, DeMail Schneider, and then and Ethan as well, right? In that supplementary handout we sent around, I think there was a directive, right, to look beyond.
I'm sorry, you came in broken, Chris?
I'm sorry?
You just came in broken. The phone was, I couldn't hear what you said.
Can you hear me now okay?
Yes, sir. Yeah.
Yeah, so I think we had, in that other slide deck, you'll see there, we had expanded the kind of some of the candidates out beyond, I think at your direction, just the short-term fixed managers. But to your point, the data that is embedded in that other deck that we'll work our way through with the board is the basis for your input, in the sense that the dollar cost averaging pool, obviously, right, we need to figure out in precise terms what its configuration looks like, right? We had started with the straw man of a very, very conservative short-term collection of fixed income strategies. There was an appetite to look a little bit further out in terms of the yield spectrum. So in that deck, you've got, in addition to some of those legacy strategies that we've looked at, we've added a few others for you to look at. And I think that'll be our exercise, right, to get a sense of what ultimately the board's comfortable with, how much we stretch for yield and return versus, the dual objective of, obviously we want these monies to be, particularly locked down and not subject to too much in the way of volatility. So that's certainly what we'll be working through with the group in time here.
Peter, go ahead, please.
Yeah, I just wanted to point out, I think the initial investment strategy is going to be a work in progress. Obviously, we're going to be tweaking it as we go along and react to any changes in market conditions. So, I think we're probably going to agree on initial investment strategies, but as the quarters pass, any change in market conditions, we're going to have to react to them like we would any other condition.
No, I think that's a great point. Shall we proceed to your other deck, Chris? I'm not sure if you had other comments on the first deck with the performance, but I'll turn it back over to you.
Okay, great. Bear with me here. Let me just bring it up on this. So we had the second attachment that we had forwarded to the board just expands upon, as I mentioned, that initial configuration of managers, and hopefully if the members have had a chance to look at that, what we've tried to do there, right, a general recognition as we've talked that interest rates remain very, very low, and trying to be thoughtful about how we tackle this particular asset pool on a go-forward basis. So we had provided previously, and you remember, catalogs, just a host of strategies, really at the very front end of the yield curve. And that obviously comes with, right, diminished yields, kind of as we sit here today and have the conversation, anywhere from, call it 50 up to maybe, 90 basis points or thereabout. So a pretty modest yield profiles, right? And the way to address that, of course, is to step a little bit further out the yield curve, fully recognizing that the curve is steepened a touch, but still pretty darn flat, right? So on margin, there are opportunities out there with slightly higher yields. Vanguard's intermediate strategy comes to mind. It yields 150 basis points today. But the other way we look at it, right, and of interest to us is just the amount of yield compensation you're receiving for the interest rate risk. So we look at something we call yield per units of duration, years of duration, I should say. And it's interesting, if you looked at the data, you'll see that generally, that statistic, if you will, skews in favor of the shorter term strategies, just in terms of a reflection of, the flatness of the yield curve. And while there's higher absolute rates, if you move out a little bit, you are accepting a good deal more in the way of interest rate risk to do so. And the information we had provided you, I think just kind of tries to make that point and offers up some other attributes around the candidate managers. So I don't know if folks have access to that deck. I'm just kind of flipping through the pages here, but we had cataloged for the board on page 3 just the mixes and the configurations of the different strategies in terms of quality and segment, if you will. The managers, right, clearly need to kind of stretch their way down the quality spectrum a touch, and you see them kind of all focusing to a large extent on the triple B areas of the market, those sources of yield, right, the lowest investment grade area of the markets, but maintaining otherwise diversified footprints on both the quality and on the segment of market, right, whether that's government, corporate, and some of the amortizing asset classes. They all utilize those in meaningful terms. And then we had wanted to provide the board, again, on that same deck, starting on page 4 of it, just the recapped performance through the end of the calendar year. We broke it down in kind of 2 basic components or data sets. One is just the short-term managers, and that's what was evidenced on page 4. And you can see there kind of the return profile, and the biggest takeaway, right, is that in this part of the market, this segment of the market, you don't see negative absolute returns very often, right? It just doesn't happen all that much. You have to go back to 2008 for a couple of the strategies where you saw them for the calendar year down a touch, and obviously what was a pretty darn awful year. Otherwise, they're kind of churning away and generating returns that are consistently positive. If you kind of switch gears, again, if you're in that same deck on page 5 and expand the analysis to the intermediate candidate managers, you see, right, a higher absolute returns longer term. Absolutely, right? You are compensated for that over time, but you will have periods and incidents somewhat more frequently of negative outright returns, right? So kind of that same expectation you would have 2008, a bit of a challenge for a certain of the managers. 2013 as well, which was a down market for fixed income, a negative returns as well over the course of a 12-month period, not extreme, but negative nonetheless. So I think our motivations here were to say that, we've got a couple of things in the arsenal about how we tackle this as a group, right? And I think we're going to have to work our way through the comfort level from the board on how much yield are we willing and able to search for and strive for, versus, again, that co-objective, right, and an important co-objective of kind of defending that principle as it gets allocated into the larger investment pool for long-term investment. So, Mr. Chairman, that was just we had provided that data as all through, as you see, the end of the calendar year. I suspect we'll continue to update this exhibit as we have, subsequent conversations on where the board would like to end up here. But we did want to get that data out just so you can start thinking about it, and we can start to, work through the details here in the particulars.
Thanks, Chris. I do have a question for you, but I want to see if my colleagues have any questions before I ask mine. Al, go ahead, please.
Yeah, Al Lebo, board member. Chris, I'm sorry for this question, but page 4, does this really say that in 2020, the Barrett and the Vanguard short-term funds returned 4% and 5% returns?
Yes, it does. Remember, right, Al, what we started with, right? So these guys are on the front end of the curve. but we've had, rates even across the entirety of the curve until very recently, right? We're in that kind of sharp downdraft, right? So the rate environment had generally been conducive. And then, of course, as you know, they do, as we talked about, step a little bit into credit. And credit, as you know, has been a kind of a home run this year as people continue to kind of try to squeak out every basis point of yield. So the short answer to your question is yes, for 2020 calendar year, the Baird short term was up 4.2, and you see the Vanguard short term portfolio was up 5.25.
So despite the fact that short rates were very low, like basis points, and despite the fact that these are short-term investments, so they're not subject to changes in the yield curve, causing changes in value. This is just credit spread. That's where this was all picked up.
Yeah, by and large, right? They probably had a little bit of a tailwind from rate start to finish of the year, but you're right. It's predominantly credit quality. So the Baird fund, Alan, right, is about 30% in triple B. And then the Vanguard strategy is about a third. It looks like 34% here on our exhibit triple B. And you folks remember, right, how kind of short rates and short credit, struggled a little bit in the first quarter of last year, but then it was an all hands on deck, huge tailwind to those strategies and segments of the markets. And you don't need to get a ton of yield compression, right, to generate a fairly decent return. So as we've talked about a million times, right, a pretty remarkable year in the markets, all things considered. But if you look, I say that, Al, right, and then we do need to frame more broadly, right? You kind of expand the lens, maybe this is of less concern to the board, maybe given the tenure of some of these strategies and their role in this larger POB effort. But, right, longer term, right, the returns are consistently more modest than that. They're down in the 2.5% range as a more typical, profile. You point out those two numbers, right? And 2019 was a very good year too, as you'll note in the exhibit. But if you kind of look prior to that, you have a pretty consistent run of much more modest numbers, right? We're not going to go through all these, but 1.08%, up 89 basis points, up 1.5. They're more modest numbers than what we've had recently. And those recent numbers are a display of just this absolutely unmitigated search for yield and investors driving those credit spreads to pretty tight levels.
Other questions for Chris about the various bond funds presented here, and we have some time, I think, to sort this out. So I don't think we have to. This is good information, and we've got time between now and the next meeting to kind of continue to refine our decision making here. But other questions for Chris on this material? Chris, the one question that I had is, as you think about, I don't know if you've started thinking about kind of a sweet spot in terms of duration, credit quality, but as you think about kind of the sweet spot, given the interest rate environment and what's happening in the markets, maybe, speak to that and maybe kind of some of the funds that you're leaning towards recommending, if you have that at this point.
And Mr. Chairman, Chris Cashmore DeMail, you mean with respect to the DCA pool?
Yes. Yeah, and again, I'm just looking high level because we have more time, but maybe just give the board some things to think about as we kind of digest some of this information on our own. Some of the things that you're thinking about and leaning toward.
Yeah. So all of the managers, I think, that we display here, right, are managers that we endorse and use, and I would dare say that we might not have down to the basis point yet. The configuration will obviously take guidance from the board on that. I do think, Lazaro, you do see kind of across these pages here, these would be the managers that in some form or fashion that would ultimately kind of bleed through and we'd use. So Again, I don't know if I can put a precise dollar amount or percentage on these. Again, it depends on your input, of course. But the managers you see here, the Bairds, the Vanguards, the Paydens, the Westerns, for example, if we do some intermediate work, are all managers we'll use in combinations that ultimately tie in, of course, to your comfort levels around the amount of intermediate, the amount of short term. And how we kind of mix and match those. So these are live candidate lists. These are real research managers and one that we use and endorse elsewhere, for similar objective asset pools. So
yeah, I was looking for high level. If you have preferences, like you show this yield per year of duration metric, and then some are higher, some are lower, and I think I know the answer. But as we kind of sort through the different managers, maybe just kind of guide our thinking here in terms of how you would look at it, and what sort of how you would narrow down the list. And yield per year of duration is one of the metrics, and fine. But I think just kind of give us some high level guidance in terms of how to look at it, and so we've got some time to look at this on our own.
Yeah, so I would. So with that direction, yeah, back to page 2 of the exhibit. I think Lazaro might be where you're centered appropriately. So you do see there, right? We do put a decent amount of stock in those statistics, those yield per year duration, and you see there, right? Obviously, a higher number is preferable to a lower number, and Baird, for example, the ultra short strategy, while it has a relatively modest yield of 68 basis points at the end of the calendar year, they've got next to nothing in the way of rate exposure, right, or duration profile. They're less than half a year, so that statistic runs pretty competitive there. So I think some combination of Baird, Vanguard short-term investment grade, right, which is very cost effective and has a respectable yield as well, might have a role. I could envision Payden having a role, right, which again, another yield profile, a yield or duration profile that runs a bit high there. So I think those are kind of the way we would tease those, and just from an entity standpoint, mix across perhaps the 3 of those. And then the larger question becomes, whether the board wants to search for somewhat higher yield in an absolute sense, right? And that would kind of carry us down into, if in fact you decide to do that, adding some combination of, or maybe one of the managers among Western, the Baird Intermediate and the Vanguard Intermediate. But again, with the recognition, right, that the duration they're at 4 to 6 years of duration, and while the yields are on the surface higher, you are exposing the corpus to that potential volatility by virtue of having a meaningfully longer duration. So I would think ultimately, Mr. Chairman, to the question, it's probably something like 4 of these managers, with maybe 3 of them centered in the front end of the curve, and maybe we pick one of the intermediate managers to add a little bit of a yield profile alongside it. All, of course, done with a sensitivity to ultimate cost, given how low interest rates are. So we'd work through all that detail. But if you, as we sit here this morning, if you said, Chris, give us the mix today, I could envision something like Baird ultra short, Vanguard ultra short, maybe some Payden, for 75% of the asset base, and then maybe the Vanguard intermediate term, right, offers the highest absolute yield, and 25% of that total might be an interesting kind of counterparty to those 3, and that being among those 4 strategies, maybe a good place to kind of start the conversation as a straw man. That makes sense, or help at all, or no?
No, it does. And again, we've got time to kind of think about this a little bit more. So thank you for that. We've got about 4 minutes left. I think I have one item. I'm not sure, if we have any new business, but before I move on to new business, we'll try to adjourn at 9. Does anybody have any other questions for Chris? Thank you, Chris.
All right, thank you, folks. And I'll get that detail on the cash work we did back to Peter.
Appreciate it. Do we have any new business items? Doesn't sound like it. So with that, thank you, everybody, and I'll make a motion to adjourn.
Okay, sounds good.
Thank you.
Bye.
Have a great day.
Thanks, everybody. Good seeing you.
Thanks, Lazaro.
Thank you.